Hey there, future real estate moguls. You've probably heard the term REITs floating around in the investment world, and maybe you're wondering, what in the world is a REIT and why should I care? Well, today we're going to dive into the exciting world of real estate investment trusts, or as we like to call them, the easiest way to get into real estate investing without needing to buy a whole building. If you're tired of dealing with tenants, toilets, and the headache of property management, REITs are a great way to earn income from real estate without all the hassle. And I promise by the end of this video, you'll know exactly how to get started. So buckle up, grab your coffee or wine if it's one of those days, and let's make REITs fun and easy to understand. Alright, let's start with the basics. What exactly is a REIT? It sounds fancy, doesn't it? But trust me, it's a lot simpler than it sounds. A REIT, or Real Estate Investment Trust, is a company that owns, operates, or finances income-producing real estate. The best part? You don't need to buy a building yourself. You invest in a REIT much like you would a stock. You can buy shares, and in return, you get a portion of the rental income generated by those properties. REITs allow regular folks like you and me to earn money from real estate without the need for hundreds of thousands of dollars, property management, or fixing leaky faucets. Sounds like a win-win, right? Now you might be asking, why should I consider investing in REITs? Why not just buy a rental property and be my own landlord? Well, first of all, props to you for having the guts to take on being a landlord. But if you're anything like me, the thought of handling broken pipes and late-night phone calls from tenants is a bit stressful. Here's why REITs are the better option for many people. Passive income without the headache. REITs provide regular income through dividends, and guess what? You don't need to pick up the phone when something breaks. REITs handle all the property management for you. Diversification of your portfolio. Buying real estate on your own means you're putting all your eggs in one basket, typically a very expensive basket. But with a REIT, you can diversify your investments. These trusts invest in various types of properties: office buildings, apartment complexes, malls, warehouses, you name it. So if one property type underperforms, you've got other properties in the mix. Liquidity. Unlike physical real estate, which can take months to sell, REITs are bought and sold on the stock market just like regular stocks. This makes them much more liquid, meaning you can access your money relatively quickly if needed. Lower investment barrier. To buy a physical property, you need a hefty down payment, but with REITs, you can start investing with a lot less money, sometimes just a few $100. That's a fraction of what it would cost to buy an entire rental property. Okay, so we know REITs are awesome, but here's the thing. Not all REITs are the same. There are different types, and each one offers a different flavor of real estate investing. Let's take a look at some of the most common types. Equity REITs, the landlord REITs. These REITs own and operate income-producing real estate. They generate revenue through rental income and property sales. Think of them as the traditional hands-on real estate companies that actually manage the properties. If you want to invest in shopping malls, office buildings, or apartments, these are the REITs you'll want to look into. Mortgage REITs, MREITs. These REITs don't own the properties themselves. Instead, they provide financing to real estate owners and operators. They make money by earning interest on the loans they provide. These tend to be a bit more volatile because they're more sensitive to changes in interest rates, but they often offer higher yields. Hybrid REITs. You guessed it, these REITs combine both equity and mortgage strategies. They might own properties and also provide financing. It's like the best of both worlds. Specialized REITs. These focus on specific types of properties like healthcare facilities, data centers, or industrial warehouses. They can offer a higher potential for growth but might carry more risk depending on the market. Alright, so you're sold on the idea of investing in REITs, but how do you actually get started? Let me walk you through the process. It's pretty simple. Open a brokerage account. Just like you would with stocks, you need a brokerage account to buy shares of REITs. Popular platforms like Robinhood, TD Ameritrade, E-Trade, or Fidelity allow you to invest in REITs with ease. Plus, many of them offer commission-free trading. Research REITs. Before diving in, make sure to do some research. You'll want to understand the fundamentals of the REITs you're interested in. Look at their dividend yield, historical performance, property types, and management team. You can use websites like Yahoo Finance or Morningstar to compare REITs and get a feel for which ones align with your goals. Diversify your REIT portfolio. As I mentioned earlier, diversification is key. You don't want to put all your money in one REIT. Spread your investments across different types of REITs, or better yet, consider an REIT ETF, exchange-traded fund, which bundles together a variety of REITs, giving you instant diversification with just one investment. Invest and collect dividends. Once you've picked your REITs, just buy the shares like you would with any other stock. Many REITs pay dividends quarterly, and you can choose to either take the cash or reinvest it through a DRIP, dividend reinvestment plan, to buy more shares automatically. Remember, the key to success in REITs is patience. While you might see some price fluctuations in the short term, the power is in those consistent dividend payouts. They add up over time. Okay, let's talk about the elephant in the room: risks. Yes, there are some risks involved with REITs, just like with any investment. But don't panic. It's nothing you can't handle if you're prepared. Market volatility. REITs can experience price fluctuations, especially during economic downturns. Just like stocks, the value of your REITs can go up and down. Interest rate risk. Mortgage REITs are especially sensitive to changes in interest rates. If interest rates go up, the cost of borrowing increases, which could affect the performance of mortgage REITs. Sector risk. If you're investing in a specialized REIT, like one focused on healthcare or retail, there's the risk that a downturn in that sector could hurt your investment. That's why diversification is so important. All right, you've made the smart decision to invest in REITs, but how do you make sure you're getting the most out of it? Reinvest your dividends. Use DRIP to automatically buy more shares. Diversify. Spread your money across different sectors and types of REITs. Stay patient. REITs are long-term investments, so don't sweat the ups and downs too much. So there you have it. You now know everything you need to start investing in REITs and earn some sweet, sweet passive income. Remember, it's all about getting started, diversifying, and being patient. REITs can be a fantastic addition to your portfolio, providing you with a reliable income stream without the headaches of traditional real estate. If you found this video helpful, and I'm betting you did, don't forget to give it a thumbs up, subscribe, and hit that bell icon so you never miss out on future financial wisdom. And hey, share this with your friends, because let's face it, everyone loves a good real estate hack. Plus, who wouldn't want to make some extra cash while they sleep? Catch you in the next one, and happy investing!